We always hear about Warren Buffett's legendary investing philosophy, but how does it actually work when you apply it to a real company right now? Well, today we're going to do just that. We're putting NextEra Energy, a huge player in the American energy scene, right under the microscope using a simplified Buffett-style checkup. Let's see what we find out.
So here's the big question for today. Does NextEra Energy have the kind of financial DNA that would make a legendary investor like Warren Buffett sit up and take notice? We're about to dive into the numbers and see for ourselves.
Okay, so here's the game plan. We've got a 4-point checklist. First, we'll look at profitability. Then we'll check out its growth history. After that, we'll poke around its financial foundation. And finally, the big one, is it selling for the right price?
First up, let's talk about profitability. It sounds obvious, right? A good business has to be good at making money, consistently. So let's look at a couple of key numbers to see how NextEra really stacks up. The first metric we're going to look at is return on equity, or ROE. Think of it this way. For every dollar that shareholders like you invest in the company, how much profit does the company spit back out? A high, steady ROE is often a sign of a really well-managed business. And NextEra clocks in at 12.51%. Now, a lot of investors would say that anything over 10% is pretty darn good, so this is a solid start. It shows the company's doing a good job turning shareholder money into actual profits. So, check one for NextEra. But that's not the whole story. Next, we have to look at return on invested capital, or ROIC. This gives us a wider lens because it looks at how well the company generates returns on all its money, not just from shareholders, but also the money it's borrowed.
And NextEra's ROIC is 4.05%. Okay, so not quite as flashy as the ROE, is it? What this kind of tells us is that debt plays a pretty big role in the company's financial picture. It's still a positive return, which is what you want to see, but it's a more modest number that paints a fuller picture.
All right, so the company can make money. That's great. But can it do it year after year and grow along the way? Buffett is famous for loving businesses with long, predictable track records. So how does NextEra do on that front?
Wow. Okay, this is where it gets really impressive. 31. Just let that number sink in. For 31 straight years, NextEra has increased its dividend payout to shareholders. Through recessions, market crashes, you name it, the dividend went up. That is a powerful signal of a stable, reliable business.
And this table, it just drives that point home. It's almost weirdly consistent. Look at it. Whether you look at the last year, the last 3, or the last 5 years, the growth rate is ticking along at right around 10%. It's like a metronome, just steady, reliable, and predictable. Okay, so we've got profits, we've got growth, but what's the foundation look like? Is the house built on solid rock or on sand? For our third check, we need to look at the company's financial health and see if there are any potential red flags hiding in the balance sheet. And our first tool for that is the debt-to-equity ratio. It's a pretty simple idea. It's like looking at your own finances. How much money do you owe versus how much do you actually own? A really high number here can be a warning sign that a company has taken on too much risk. So, NextEra's number is 1.75. That means for every dollar of its own money, it has borrowed $1.75. Now hold on. In an industry like utilities, which has to spend billions on power plants and infrastructure, carrying a lot of debt is pretty normal. Still, this is on the higher side, and it's definitely something a conservative investor will be watching closely. Next up, we'll check its short-term health with the current ratio. Think of this as the company's rainy day fund. If all its bills for the next year came due tomorrow, does it have enough cash and other easy-to-access stuff to pay them? You'd really like to see this number be over 1. And NextEra's is 0.60. A ratio below 1 means it has only 60 cents in liquid assets for every dollar of bills due in the short term. Now again, for a stable utility with very predictable cash coming in, this isn't necessarily a 5-alarm fire, but it's another little yellow flag about its financial leverage that we need to keep in mind. And now for the final check. This is the big one, the moment of truth. Because you can find the absolute best, most wonderful company in the entire world. But if you pay too much for it, it can still be a terrible investment. And this is where that classic Buffett quote comes in. It's not just a cute saying. It's the core of his entire philosophy. You protect yourself from losing money by buying with what he calls a margin of safety. In other words, buying a great business for way less than what you figure it's actually worth. So what does that mean for NextEra? Okay, look at this. On the left, we've got the market price, what you'd pay for a share today, about $95. And on the right, we have a fair value calculation. an estimate of its intrinsic worth at just over $32. I mean, wow, that's not a gap, that's a canyon.
And here's what that looks like is our key number. The margin of safety is a negative 196.5%. Let me be crystal clear. You want a positive number here, a big, fat positive number. This is the exact opposite of what a value investor is looking for.
Okay, let's take a breath. We've thrown a lot of numbers around and put NextEra through the ringer. So let's put it all together on a final scorecard and see what we've actually learned. So here it is. Profitability, strong ROE, we'll give that a pass. Growth, that incredible 31-year dividend history, oh yeah, that's a definite pass. Financial health, with the high debt and the low current ratio, we have to give that a caution. And then price. With that massive negative margin of safety, from a strict value perspective, that's got to be a fail.
And this really hammers home one of the most important lessons in all of investing. Based on our little checkup, NextEra has a lot of the qualities of a fantastic business, but that doesn't automatically make it a great investment, especially at its current price.
So that leaves us with a really tough question, one that you kind of have to answer for yourself. You've got what looks like a great, high-quality company, but it comes with a really, really high price tag. So what do you do? Which one of those things matters more to you as an investor?